Hi everyone, thanks for coming tonight. I really appreciate it. Also, thank you for some of the guys who came from the interstate for making the journey to come here tonight. And a quick thank you to my wife for organizing tonight's event. How did sort of the whole boat fund begin? As some of you know, myself and Sam, we're extremely passionate about the stock market. We've been investing for the last 10 years, our own personal funds and our family funds. And about 3 years ago, I met Sam through a mutual friend of ours, Ivan, who's just here in the corner. And together, we realized that we have a very similar investment philosophy. We started researching stocks together. We met management. We took a real sort of hands-on approach in understanding the businesses, and we took quite sort of large stakes in small caps companies together. After about a year of doing so, we decided that we wanted to share our ideas with other investors. So we started a Facebook page called The Boat Fund. Why The Boat Fund? Well, the idea was that a group of investors get together, share their ideas, make enough money to buy their dream boat. We ran that for about 12 months. Like Peter said, we had a dummy portfolio for every stock that we invested in. We wrote the rationale behind why we invested it in, and then we put it in that dummy portfolio. After 12 months of running the Facebook page, it became very popular. There were about close to 5,000 sort of daily readers who used to follow it, and we started being approached by a few different institutions, and luckily enough, Peter and his team, they approached us, and we're here today. We're just going to tell you a little bit about the philosophy of the fund, and I'll let Sam take over.
So as the ex-lawyer, I get the pleasure of drawing your attention to our disclaimer. Just like you to please read through it, and just keep in mind that nothing. Is that better, guys? Yeah. Did you get my first joke, or? If you just please read through it and recognise that nothing this evening constitutes a recommendation or advice. Obviously, consult a appropriately qualified advisor before you choose to make a investment decision. Okay, so this slide provides a brief snapshot of our fund. Basically, as you'll see, our investment universe, with the first point, basically consists of small cap stocks listed on the Australian Securities Exchange, predominantly industrial stocks that we're looking at, all at the time of investment with a market capitalisation of under $500 million. We are high conviction investors, so consistent with that philosophy, we're actually looking at constructing a portfolio of between 10 to 20 stocks. We believe that's the sort of right balance to provide the benefits of diversification, but not compromising our ability to generate outsized returns. Basically, our key goal in running the fund is to generate high returns, and so doing that, beat our benchmark, which is the ASX Small Ordinaries Index. As you'll see from the slide, we're basically a long-only fund, and we hope to generate our returns through both capital growth and income as well. Another key feature of our fund is that we have a flexible mandate to outperform. So we retain the flexibility to hold. What that means is we retain a flexibility to hold high levels of cash. We think it's a real folly where investment managers are forced to invest in overvalued stocks because of the mandate, and consistent with that, we have kept our capacity to hold between 0 to 100% in cash where we can't find appropriate investment opportunities. Okay, so as potential investors considering investing in a small cap fund, obviously a key question is why invest in small caps? We believe this is a sector of the market that offers the greatest degree of pricing inefficiency. That is the gap between price and value. There's a number of possible reasons for this. Probably the one postulated most often is that there's quite a limited amount of institutional research that looks at this area of the market. But whatever the case, whatever the reason, basically it provides an opportunity for investors such as ourselves to exploit this and capitalise on it, and that's what we intend to do. And we intend to do that by combing through the universe, meeting company management, and undertaking extensive financial modelling. And through doing that, we believe we're in quite a strong position to outperform the market. Another key feature of this section of the market is that small cap managers tend to be heavily owned by their management. The management usually have quite a fair amount of skin in the game. So in our experience, that generally aligns their interests more greatly with shareholders, and that's something that we really look for. And we've also found that with these managers with this sort of skin in the game, they're more approachable to investors to talk about their businesses. So it gives us the opportunity to basically get a much clearer insight into those businesses through that sort of access. Another key reason for investing in this sector of the market is basically historical outperformance. A number of studies have been undertaken across developed markets across the world over varying periods of time, and many have consistently shown that small caps as a subclass of equities has tended over the longer term to outperform, although it should be said that over the short term it can display higher volatility. Another key aspect which many investors that aren't familiar with this area of the market is that many small cap companies actually pay quite healthy franked dividends. So that's another area that can generate returns through income. Okay, so if you're sold on investing in this sector of the market, then the next question for you guys is why you invest your money in the TBF Small Cap Value Growth Fund and entrust your money with TBF Investment Management. Our investment committee, which is the primary investment decision-making organ of our company, is made up of 6 members, as Peter introduced at the start of this evening. Combined, all 6 members, we have over 50 years of experience investing in financial markets, both here and internationally. Francis spent many years in London. So combined, we feel the committee can draw on basically we spoke also at the start about the different career backgrounds that each of us present, and we believe that the committee can draw on this quite broad experience. Some of us have started and operated our own businesses as well. So through that sort of broad experience, we can all draw from that, it assists in us presenting a fairly entrepreneurial approach to our investing, and we feel that experience actually gives us quite a key competitive advantage over other fund managers that perhaps don't have that breadth of experience. Our philosophy is actually pretty simple. We look for profitable businesses that are generating cash, that have a growth profile, that are run by honest management that have skin in the game. And obviously we're always looking to buy a stock for less than what we think it's worth. Following that approach, we basically scour our investment universe, looking for those sort of stocks and looking to buy with a large margin of safety. Another key philosophy of ours is that cash is king. So we spend quite a lot of time and emphasis on going through the financial statements, and particularly the cash flow statement, to make sure that the accounting profit matches up with the cash flows. And our saying is that basically the cash flow is accounting profit on truth serum. So we place a very high importance on cash flows. Our key idea is that we're considering each stock as a real business, and we're thoroughly analysing it, the business and its management, as if we were to be part owners or partners in that business. We don't want to get stuck behind our sort of computer desks and chairs, sort of plugging out things behind the computer, which we do, but we also want to get out before management as well, and sort of develop a fairly in-depth understanding of the businesses through that. And just the last point as well, I've sort of touched on it, is that we are high conviction investors. So we feel that when we find those really exceptional opportunities, we want to have the flexibility to swing big on those opportunities, and that's how we want to generate outperformance. That's sort of a key summary of our key philosophies, and I'll just hand you over to Ron.
So now we'd like to discuss with you about a couple of examples of how we applied our investment approach on a personal level before the fund was set up. I'd just like to make a quick disclaimer that these two examples are by no way any recommendation to do anything with these stocks, and as the fundamentals may have completely changed from when we invested in those stocks. So Jumbo Interactive. Jumbo is the largest online reseller of lotto tickets in Australia. They do about $100 million of lotto sales online. They buy their tickets from a company called Tattersales, who they have a contract with. The market perception at the time was that there was a renewal risk with that contract for Jumbo, and therefore Jumbo was trading at a very low multiple to its earnings. We identified the company, we researched it, we followed it for a while, and we were looking for a catalyst to re-rate the share price. For us, the catalyst was a new contract that will diversify the company and de-risk it. In January of 2012, Jumbo announced a new contract with a new provider, and so for us that was the time to approach the company and to take a position. We flew to Brisbane. We met with the founder, Mike Veverka. We struck a deal to finance the staff options and then buy those shares off them. We did that at 68 cents, and within 12 months the shares were $3.28. So that's just an example of how we sort of used our approach and to capitalize on it. And just to give you an idea, that deal size was $1 million. So just an idea. Another example of how we applied our approach, again on a personal level before the fund was set up, was a company called Vision Eye Institute. Vision is the largest group of ophthalmologist clinics in Australia. The market perception at the time was that the company had quite high debt levels from the good old days of when they bought clinics for a lot of debt. And the shares were trading at extremely low levels. We identified the company, we researched it, we met management, and we actually found that there's a very good defensive business that generates a lot of free cash, and it just had too much debt. For us, the catalyst for a re-rating by the market was an equity raising to pay down debt, and so to allow management to grow the business and pay dividend to shareholders. We put our hand up several times to several brokers who were dealing with the company that we wanted to be part of any imminent capital raising. This approach led us to be one of the largest sub-underwriting groups for the capital raising, which happened in January this year. We sub-underwrote a $5 million raising at 34 cents, and within 6 months the shares were trading at 81 cents. So again, another example how we applied our approach, identified the catalyst, and used a bit of entrepreneurial approach to capitalize on the opportunity. And basically, we were looking to emulate this past success going forward with the fund. So now that we told you what stocks we bought in the past, when would we have sold Jumbo or Vision? Well, there's 3 reasons why we would ever sell a company. The first reasons, if the company no longer fits our mandatory investment criteria, meaning if the business fundamentals have changed since we first bought the company. So for example, if the company made a big acquisition, took on a lot of debt, and then we may decide that the fundamentals have changed and we may decide to sell it. The second reason why we would ever sell is if the current share price appreciated way above what we think the company is worth in the next couple of years. and therefore we would potentially sell it. And the final reason why we would ever sell a company is if, for example, we would be quite fully invested and we find a very good opportunity, and therefore we would look to sell an opportunity that has a lower upside into an opportunity with much bigger upside. So just to summarize, we're a high conviction and focused boutique fund. We're targeting high returns over the long term. We're going to use our entrepreneurial approach, as Sam discussed before, to find opportunities. And I think most importantly is we're going to be investing your money as if it was our own. So I think that's quite important. Just quickly, our vision for the fund. So the vision of the fund is to consistently deliver outperformance returns while establishing a long-term and transparent relationship with our investors. So we emphasize 3 points here. One, we're targeting high returns over the long term, and we're looking for investors who would like to be with us for the long term. And we aim to be a transparent fund, meaning that over time we will be disclosing the investments that we take in the fund once we completed buying or selling a position. This will be done through our quarterly and monthly reports. And the reason for that is that we believe that every investor should know where their money is being invested. So that's our vision. And just quickly before we finish, just a snapshot of where we are today. So we launched the fund on the 1st of May, 2 months ago. Since then, as of a couple of days ago, the fund was up 3.96%. During that same time, our benchmark, the ASX Small Ordinary Accumulation Index, is down just under 10%. And, just to sort of give you an idea, the average one-year term deposit is 3.75%. So even though we're focused on the long term, and these are early days, I guess it's nice to be up. And that's about it. So now it's over to you. If you have any questions, feel free to ask all the hard ones. We're happy to answer. And if not, then that's about it. If you do want to discuss with us anything, you can feel free to call us anytime during the week. And in the little USBs that we gave you, there's the PDS, which includes more information about the fund, our fees, and so on. So thank you. The question was how many stocks we currently have in the fund. Okay. We currently we got 12 stocks. Some of them we're still building positions in. Most of them, I think. And we're about 50-60% invested at the moment. The benchmark is the ASX Small Ordinary Accumulation Index.
Calculation to calculate your fee relative to the performance on the ASX. How do you set a benchmark on the ASX?
How do we set a benchmark?
Sorry, I didn't hear the question.
So can you just repeat the question? Sorry.
It's a calculation in the PDS that pertains to the performance above the ASX.
Yeah, so the small...
Where's the ceiling on the ASX and how do you calculate?
Well, so the benchmark is a Small Ordinaries Accumulation Index. So part of our fee structure includes an outperformance fee, similar to many boutique funds. So that's the index that we use to benchmark the outperformance. So all of the fee information is in the material we've given earlier. Does that answer your question sufficiently? Or? Okay, so the index will calculate a figure, that's done, and our fund will benchmark against that figure. So to the extent it is larger than that figure, then we'll take a fee for the outperformance. Yeah.
But you have a question?
What kind of percentage would you be looking at, say, per annum to be achieving?
Okay, the question was what percentage are we looking to achieve in the fund? We don't have any sort of stated target returns, but just on a personal level, I would be quite disappointed if over the long term we weren't able to achieve over 10-15%.
Have you had any real stinkers? Because with small caps you can. Have you had any real stinkers that you wish you hadn't got into? And if so, how did you handle it? Provided they're not companies I've been involved.
The question was if we've been into any stinkers in the past. We all had our mistakes. I got to be honest, since myself and Sam got together 3 years ago with some of our other investors in the group, I don't think we really had any stinkers for 3 years, except there was one takeover arbitrage that we did do. It was on our Facebook page. We got it wrong, we admitted it, and it's something that we're going to try and avoid in the future. Obviously, over my investment journey personally over the last 10 years, as I evolved, I made plenty of mistakes. And I guess, when you do make a bad investment decision, you start getting those back pains in the morning. And the only way to get rid of them is just to sell and admit you made the mistake and move on. And you really feel much better afterwards. So do you want to answer that? The question was, how do we manage a redemption process?
Yeah, I mean, the sort of redemption profiles in the PDS, I think you're talking a couple of days in general circumstances where you put through your withdrawal form and you'll get your investment back. There is a slight provision there that deals with sort of exceptional market circumstances, that the redemption process will take a little bit longer. I mean, the full details off the top of my head I don't know, but it's in the PDS, in the additional information. The LIC structure that you mentioned, certainly, that's a key feature of that structure, but, it sort of weighed up the pros and cons of the managed fund structure as opposed to the LIC, and we saw most of the benefits with the managed fund in terms of our first venture. So that's why we went with it.
The question was if myself, Sam, and our families are invested in the fund and would be recommended to our mums. Yes.
Actually, my mum's just back here, and I'm filling out her application this week. So there's your answer.
and yes, we are invested. We are committed to invest quite a large proportion of our money over time. And I mean, my family is overseas, so they can't really invest. But my father-in-law is right there, and he's a big investor in the fund. No, it's okay. That's it?
Well, just in regards to the performance fee, is that 20% still triggered even if the fund has a negative performance? So as long as you beat the benchmark, or is there only numbers?
So with our performance fee, so basically our fees are 1.5% management fee, which is quite in line with other boutique funds, and our performance fee is 20% of the outperformance of the benchmark. The question is do we get a performance fee if it's a negative return but it still beats the benchmark? Is that correct? Well, the answer is no, we won't get that. It has to be a positive. It has to be a positive return, yep. So otherwise it's cheating. Yeah.
Discretionary investments relative to M&As and so on. How's the fund
Okay. We do have. Do you want to answer this? The question was, in our PDS, we talk a little bit about participating in M&A arbitrages and so forth.
Yeah, I mean, we've got some flexibility to participate in those opportunities. So we sort of shy away from the M&A arbitrage opportunities. I mean, we will do it if we think that, you know, there's a very low risk of investors' capital and there's a potential to make a decent return. Other sort of opportunities are like IPOs. For instance, we participated in the Virtus IPO recently. We actually stagged that. I think we got a 10% return on investors' money. So, you know, we're going to have the flexibility to look at those opportunities, but it's certainly not the core focus of the fund. I mean, the core focus is finding great businesses that are trading less than what we think they're worth.
Ron, does your mandate allow you to invest overseas?
It doesn't. The question was, does our mandate allow us to invest overseas? And the answer is no. But maybe an international fund in the future. So just repeat it. The question was, do we have to hold minimum cash levels to retain liquidity for any redemptions or withdrawals? And the answer is that, you know, most likely we will, you know, never be 100% invested. We will manage that over time. So yes, there will always be some level of cash to enable redemptions if necessary. Yep. Okay. Well, again, thank you, and then I guess just a chance now for everyone to network and meet each other, and we're still paying for the drinks for the next hour, so enjoy it. Thank you.